Deciphering the balance sheet. A balance sheet is a snapshot that provides a financial picture of a company at a specific point in time. Usually that time is the last day of a month, a quarter, or a financial year. Standards of accounting dictate that at least 2 snapshots or periods are shown. For example, you can look at the balance sheet for a company as of December the 31st, 2012 and December the 31st, 2013. The balance sheet provides information on: number 1, assets. The resources and items you own that have economic value, such as cash, accounts receivable, buildings, equipment, and other things used to generate revenue or income. The balance sheet also provides information on liabilities, which are the debts you owe to others, such as bank loans, accounts payable, and mortgage loans. Third is equity, what the owners of the business would have left over after selling off all of the assets and paying off all of the liabilities. Assets, liabilities, and equity, these are all the factors of your asset strength, along with the income statement, can indicate how effectively your company's assets are being utilized to produce return. Asset strength is a very good indicator of financial health, because a company can rely on its assets when things go wrong. Strong assets with few liabilities means a company can survive financially at times of trouble or crisis. For example, if your company has 3 million Egyptian pounds to be repaid in 60 days, and 8 million Egyptian pounds in cash or assets that can be turned into cash within 60 days, the company is in good shape. If it is the reverse, then things are not so good. Banks, investors, and analysts review a company's balance sheet closely to determine the amount of risk involved in loaning money to, investing in, or buying stock in the company. What they want to see is enough asset strength to cover all of the possible events that a business is exposed to every day, such as downturns in the market or failed launch of a new product. The balance sheet formula: assets equals liabilities plus equity. The balance sheet shows a company's assets and the sources of capital used to acquire or fund those assets. The balance sheet balances because it shows that the money to purchase the assets came from the total of what was borrowed plus what was earned or contributed from the owner's pockets. A simplified balance sheet reads as follows: cash and cash equivalents plus other assets equals total assets. Subtract the total liabilities and you get the total shareholders' equity. If you only have a couple of minutes to look at a balance sheet, quickly look for the following 4: cash position change, equity ratio, and return on assets. Cash position. A company's cash position is the item listed as cash and cash equivalents. This reflects how much cash the company has on hand or in accessible accounts at a point in time. You want to see a strong cash position on the balance sheet. This means that the company can survive tough times. The worse the economy, the more important the cash position becomes. Cash position change. Look for how the company's cash position has changed over the years. An increase is usually a good thing, unless the company is keeping too much cash, as that represents lost opportunities and not enough investments in growth. If the cash position has decreased, why has it decreased? Has the company used cash for big investments? Or have revenue and profits declined, forcing the company to dig into its cash reserves to sustain itself? Equity ratio. Divide the equity by total assets and multiply by 100 to get the equity ratio. A higher percentage means that the company relies on its owner's equity to finance its assets. A higher percentage also means the company has more equity to borrow against, in case it wishes to use loans to finance itself. Finally, return on assets. Return on assets is a measure of profit generated on the company's assets. Divide the net income by total assets and multiply by 100 to calculate the ROA. The higher the percentage, the better. Profits are the best kind of return. Now let us take a look at a real balance sheet that is very relevant to you. The following is an excerpt from Etisalat Group Annual Report for year 2012. Now that you have taken a quick look at a balance sheet example, let us break down the major components of a balance sheet The following is an excerpt from Etisalat Group Annual Report for the year 2013. The first item is non-current assets. These are assets that are fixed or long-term. These assets are not intended to be turned into cash in the next 12 months. A company with more cash than it needs in the short term will look for ways to invest it for higher return in longer-term assets. Current assets. These are assets that the company expects to convert to cash within the next 12 months. As we learned before, cash is the most liquid asset. It includes funds in banks and other financial accounts, as well as cash equivalents, such as interest in a money market fund. As a general rule, you want to see cash increasing over time, unless the company makes a strategic decision to use the cash in investment opportunities, paying dividends to shareholders, or maybe paying bonuses to employees. Third is non-current liabilities. These are the financial obligations that extend beyond 12 months, such as long-term debt. Current liabilities. These are the liabilities to be paid within 12 months. An important question when reviewing current liabilities is, are there enough current assets to cover all current liabilities? Although liabilities are necessary in most companies to finance and grow operations, too many liabilities can be troublesome. More liabilities means greater interest payments. Interest payments impact the bottom line. Finally, equity. Equity is used to calculate several ratios. One of the most important is the equity ratio, which measures equity as a percentage of assets. A high equity ratio suggests that a company has a lot of equity to borrow against if it needs to raise cash. Another is the debt-equity ratio, which is total liabilities divided by total equity. These are some points to remember about the balance sheet. The balance sheet is a snapshot taken at the end of a month, quarter, or year. It is used in comparing the financial status of the company between two snapshots or two specific points in time. The balance sheet formula is assets equals liabilities plus equity. The balance sheet primarily measures a company's financial strength. It has a particular focus on liquidity and ratios of debt to equity and assets. The balance sheet must balance the amount of assets with the source of funds to acquire them, that is, the liabilities coming from creditors plus equity coming from the owners. Keys to look for in a balance sheet include cash, current assets, current liabilities, total liabilities, and equity. Net income from the income statement divided by total assets on the balance sheet is what is called return on assets, which is a measure of productivity. Equity is equal to assets minus liabilities. Equity is generated through shareholders investing in the company and by profit being retained by the company. Debt-to-equity ratio indicates how much debt is used to finance the growth of the company over time. The following are things that you can do to positively influence your company's balance sheet. Number 1, reduce or eliminate non-producing assets. Number 2, acquire more effective assets. Number 3, make better use of or conserve cash. Number 4, negotiate better terms on credit or debt. Number 5, improve profitability using existing assets.